I'm Charlotte McLeod with the Investing News Network, and here today with me is Nick Hodge, editor of Daily Profit Cycle. Thank you so much for joining me once again. Great to see you.
Charlotte, always good to be on the show.
It is good, and we're here in New Orleans, and we're going to talk first about your upcoming presentation. I always like to ask you about them because you give them the most creative titles that I usually see. So this time around, it's Memes and the Moon, a requiem for rabid Redditors. So can you unpack that and give us a bit of a preview?
It's a lot of alliteration in there.
It is, yeah.
Well, we've had a meme stock mania, or at least we did coming out of COVID, where a lot of retail traders came into the market sending up stocks that were seemingly not the best investments on paper, based on fundamentals, AMC and Bed Bath & Beyond, GameStop, excuse me. And those have all sort of come back to earth, but it's sort of infected the precious metal space as well. We've had a big movement online with, silver squeezes and stacking silver and, Wall Street silver and this whole meme stock mania on Reddit. And what I came to see is that they've almost been like an inverse to what's going on, or sort of a contra stream, as it were. When I went back and I looked when they first came on the scene and we're talking about a silver squeeze, marked nearly the very top of the silver market for the past 2 years. Silver was at like $28 then. And in the newsletter that I write called Foundational Profits, a monthly newsletter, we were selling silver stock. I took that to be, contrarian to their seemingly contrarian take, to sell them the stock, because when I saw this rush of retail traders coming into the silver space, it was, to me, a time to sell. And that turned out, in hindsight, to be 100% correct. And so a requiem for rabid Redditors is sort of talking about why you can't invest based on, the meme of the day or what the social media flavor might be, because that's not necessarily what's going on in the market. And, certainly we live in interesting times. We've had historic high inflation, and typically that would be a good environment for gold, but it has turned out not to be, and for silver as well. So, I was reading articles about people who didn't have a lot of spare cash that were putting what little spare cash they did, half of it, for example, into stacking silver coins. But if you did that back in March of 2020, March of 2021, you've lost 25 to 30% of your value, right? Whereas the real hedge to inflation, at least in this current cycle, has been the dollar, which those Reddit armies are seemingly against, right? They often tell you the death of the dollar is here and the dollar isn't worth anything. But, the dollar is the strongest it's been in 20 years and has proven one of the most safe havens to be in this current climate. And so, and the same with Bitcoin, and the same with those other stocks I mentioned earlier. All those are down. Bitcoin's down 60% from its highs. AMC and Bed Bath & Beyond have come all the way around. And so I see all these memes about things going to the moon, and I wonder which direction the moon is.
Oh, goodness. Yeah. And I wonder, so we recently had a little bit of a silver squeeze revival. I saw it trending again on Twitter, I think toward the end of last month, early
Correct.
this month. So what did you make of that?
So it's the same exact thing, right? They call it the 2-month top again. When the silver hashtag starts coming on Twitter, it's the top in the interim for the silver market. And what happened was there was a bit of dollar weakness. There was a bit of bond weakness. The Bank of England had come in and said, we are going to actually buy some bonds. We're not going to do as much tightening as we said. And gold had its best week in, I think, 3 months, something like that. It went back over 1,700 briefly. Silver went to nearly $22 briefly. But if you look today, as we record this interview, silver's back down to $18. That hashtag that trended that week you're speaking of was the immediate term top for the silver market. And that's what I mean by them being a contrarian indicator and the thinking they're contrarian themselves.
Well, that's tricky because we do always wish for new people to come into the precious metals market. We want to see new investors, but then I guess maybe we don't necessarily want it in this way.
So you're exactly right, and I hadn't necessarily thought about it in those terms. I guess what I'm saying is that, and I get into it in my presentation here. Yes, you should have a small allocation to physical metals. Yes, you can hold some gold backed or some gold ETFs in your portfolio, but to be committed to a hashtag, to make that a way of life, or to think that's the only thing that's to invest in, and not want to hear about anything else, certainly like the dollar in this case, which is, like I already said, very strong, you're not doing yourself any service. In fact, you're doing yourself a disservice. And so there will be a time for gold and silver, and maybe we'll get into that in this interview. But it's not now, and it hasn't been for the past year, because of how strong the dollar has been and because of how strong bond yields have been. And so I've been quite bearish on a lot of things, especially as it relates to the macro environment. And so, if you look back to previous recessions, it's always after. And I said this the last time you and I spoke. It's after the recession that the metals start to perform and the commodities start to perform. And so, you've got to get through this current recession first. To foam at the mouth every time silver has a little bit of an up day is not the way to play this game.
Yeah, I mean, you'll get worn out, I think, very quickly if you do that. So, good point. Yeah, let's talk a little bit more about gold and silver and what the timeline looks like there, because we are hearing, especially at this event, nobody likes the dollar. Nobody is going to tell you that you should look at that. And we're hearing about the recession, but it does get a little bit muddled when you talk about when gold and silver take off in relation to the recession. So what are your thoughts there?
Yeah,
As you said, after.
it's after a recession, and in this environment, it's when rates start to come back down.
Right.
So really, that's what's kept a lid on gold, and that's why everyone has been saying, we're waiting for a pivot. We're waiting for a pivot. I take the liberty to silence the T and make it like the play, right? We're like waiting for a pivot. Like there's the play where Godot never comes, right? And I don't think you're going to get the pivot for a while here either. Jerome Powell seems intent on continuing to raise rates. Inflation remains stubbornly high. While we were at this conference, we got a CPI print that said, core inflation remained at 40-year highs. And I think they're going to do more. They haven't had a soft labor market yet, which is yet to come. And, this is going to work through the system for a couple of quarters. There's a disappearing wealth effect. If you think back to, the pandemic and the brief recession that caused, everybody got mailed a check, whether you were a small fish and you got your stimulus check, or you were a big fish and you got your paycheck protection plan here in the United States money. All that money is sort of gone now. People spent that money, and you're seeing that come into earnings, which is probably the next thing I should mention. So corporate earnings are going down. They were very high in 2021, and we're starting to see those come down drastically. Big companies have warned that are bellwethers. FedEx has warned that we're entering a global recession. The McDonald's CEO has said we're entering a global recession. And the banks will start to report this week. And so, and earnings growth isn't even negative yet. It's come down from like a year ago in the third quarter of 2021. S&P 500 earnings growth was 40-some%, 40. And now this quarter it's going to be still positive, but probably in the 3 to 6% range, right? What happens when corporate earnings growth goes negative, which we're probably approaching in the next couple of quarters? And so, if I have to crystal ball it, it's mid 2023 before you work through this malaise or this sort of economic contraction that you're in. It's tough to defy gravity, which has happened for a decade, really, since the last recession. We haven't had a good one, and you're there now. And I view it as people working themselves through their stages of grief. I see them starting to bargain.
Yeah, okay. And so we also talked last time about debt levels, and I think the way the conversation went was we were talking about once the Fed realizes that the debt is too high, that's when it pivots or pivots. I do like a good literary reference. So is that still your feeling there? Because we did get that report saying U.S. debt is 31 trillion.
31, yeah.
And you'd think that might make some impact, but it kind of seemed to fade away.
Yeah, it did fade away, and I'm not a Fed watcher per se, but everyone's got their opinion, I guess. And so we've seen other central banks have to pivot if we're going to keep belaboring it. The Bank of England turned around and said, we're not going to tighten as much as we first said. But like I say, here in the United States, with still relatively robust employment, the Fed seems intent to continue raising. When does something break? That's what everyone is wondering. And I would argue things are already starting to break in some respects, right? You've got a stock market in the S&P that's down some 25% for the year. You've got the worst start. Well, it's not even a start now. We're in the third quarter, one of the worst years for bond markets on record. High yield, junk corporate debt has started to break a little bit. And when does that spill over to the Fed is anyone's guess. They probably have 2 more hikes in them before, something cascades. If you look at credit default swaps, which again, I'm not a thorough expert in, I mean, some of those things are starting to break as well. If you look at Credit Suisse and Societe Generale, for example, I mean, the banks are really struggling with the rates going up so fast, and certainly it's spilled over into the housing market a bit. So people are starting to be affected. Does the Fed care? I'm not so sure. Jerome Powell is talking a good game, says to expect some pain. At least I'm telling you that he's not going to stop, right? I mean, people are still waiting for the pivot. So to answer your question, I guess I'm not going to answer it. It's going to be several quarters still, I think.
So last time we also talked about, you mentioned a breaking in the bond market. You brought that up again right now. And I wondered if you want to touch on what we saw at the Bank of England and how that may play into this situation, because that's something I'm kind of curious about.
Yeah, again, I'm not a Fed expert or a central banking expert, but it seems that people, countries that aren't denominated in the dollar, which is all of them except for the United States, are feeling the pain, right? Because they have to buy their goods, they have to buy their commodities in the dollar, and so they have to be accommodative on the policy front. The way that the Bank of England saw things. There was pension funds, long-term funds in that country that were dependent on the bond market to hedge, and so they started spiraling out of control as sort of bonds sold off and rates went up, and so they had to step in and start buying bonds to prevent some of their pension funds from collapsing. Is there contagion? Is that going to spread into the U.S.? I'm not so sure. Again, I see these meme people start foaming at the mouth, right? The Bank of England is pivoting. It's the end of the central bank. And it's like, well, I'm not so sure that's the case. They've been able to kick the can for a long time already. And I think they'll continue to be able to execute their policies as they say they're going to do. Not everything's a conspiracy. And so I didn't pay huge attention to it. I don't think it's going to affect the greater market, which seems to be led by the U.S. at this point.
Okay, and so I think for at this conference, one of the reasons people come here is they want to know what to do with their money. And what does this add up to for you in terms of, because you've been talking with the U.S. dollar.
Yeah.
That, and would you say, people should be in cash right
Yes.
now? Yes.
So, I focus on two things in my newsletters. I have a retirement safe money newsletter that's monthly, and then a speculative newsletter. And they all mirror what I'm doing with my own capital. So in my IRAs, in my retirement accounts, in my safe money, I'm 50% in cash. And we started with a third in cash earlier this year. And when Jerome said in Jackson Hole that you should brace for some pain, we went to a larger portion of cash. So yeah, half our assets are in cash. There's a little bit in gold, and then there's some in some safe, relatively safe dividend-paying stocks, consumer staples I'm talking about, like Altria, for example, like tobacco stocks. But we don't own a lot. We own some physical gold and 50% cash. And I think you're in a storm that you're going to have to ride out right now. Catching falling knives is a tough business. And even if you think back to the summer, for example, you had the S&P rally from June until sort of the end of August, and everybody was saying, the bottom is in for this current bear market or whatever. And I was saying, I'm not so sure. I was talking about the earnings that I mentioned earlier in this interview, and sure enough, here we are, lower than the June lows. All the gains from June to August in the S&P have been erased, and so. It's not always what people want to hear, but cash has been the place to be and continues to be the place to be, unless you play the short game, which a lot of people aren't comfortable with, shorting stocks or buying puts or whatever it is. So it's 50% cash for me. I mean, I lay it all out there. It's about 30% gold, and that's physical gold in quotes in the form of ETFs and large dividend-paying gold stocks, and then consumer staples. So there's not a lot to like out there, and I think things are going to get cheaper. So, you don't want to, get lulled into a bear trap, as it were.
Right. So for you, I guess we need to get through this coming storm, and that's more when it would be time to get back.
Absolutely. There will be a time to buy stocks again. There always is, A lot of people haven't been through a bear market. The last real one was 12 years ago. And so, not as old as some of the people here at this conference, but I was in the markets in 2008, and I remember, how low things can truly go. And let's look at some historical valuations, for example. If you look at the S&P on like a P to E basis, a profit to equity, or excuse me, a profit to earnings, or you look at a profit to sales, they're still above average historically. And so there's further downside to go, and I know people don't like to hear it, but they gotta take their medicine in some respects.
That's true. So we've gone over some of the bad stuff. I want to take a look over at uranium, which may be a little bit more optimistic.
Let's do it.
We'll find out. So we had what I think is big news this week. We had Cameco team up with Brookfield Renewable to acquire Westinghouse Electric. So Could you tell me about what you think that means for the sector? Is it a big deal as I think it is?
Yeah, before I get to it, let me say that there are some things that are doing okay.
There you go.
We have seen a commodities pullback, but you have lithium prices that remain at what $70,000 per ton of lithium carbonate, and you have uranium, which is still positive for the year. I mean, it's come down from $60 a pound or near $60 a pound to just below 50, but it's still up for the year, and I do think there's some opportunity there. If you're very selective. And so the fundamentals, as many people here will tell you, including Rick Rule and others, are have never been more bullish for uranium. You see countries capitulating. You see Germany saying we have to leave on the nukes. Japan is now saying they want to turn all their nukes back on. France, which had lots of their plants idles, are wanting to turn all their plants on. And we talked about Russia in the last interview. The gas from Russia isn't as reliable as it once was, and so people are starting to realize, hey, we've got to rely on this nuclear, not just for energy security, but for their climate goals as well. So you mentioned the Westinghouse deal. Well, Cameco came in to buy 49%. I think they put up 2.2 billion. And Brookfield Renewables, which is interesting, renewables, right? I mean, nuclear is not necessarily renewable, but it's firmly now made the transition to a clean, accepted energy form. Bought the other half, and then there was some debt involved to make it an $8 billion deal. I think Cameco is looking to be the biggest fish in the pond. This was a company, Westinghouse, that was bought out of bankruptcy a couple of years ago. They had some slowdowns in projects they were building in the United States, in Georgia and South Carolina. It was taken private by a private equity group, and now Cameco I think that they can vertically integrate as the largest public producer outside of Kazatomprom, and so they were citing extremely bullish nuclear fundamentals for the reasons that I just said. And I think it's going to be a good long-term move. And in fact, Cameco would be one I would look to buy. We were in the monthly letter a while ago, and we sold in Uranium's last run. And it got quite cheap because they had to sell a lot of shares to finance this deal. So they did a $650 million bought deal financing, and shares came down off the top of my head, I think from near 30 to down around 24, 23, something like that. So there's opportunity as these broad sell-offs. Babies get thrown out with the bathwater, and so. The other deal that happened is UEC bought Rough Rider, or is trying to buy Rough Rider. It's not closed yet. They've been making a lot of deals as well. They had a bidding war for UEX with Denison a couple of months ago, and then before that, they bought the Russian assets that Rosatom had purchased. And so, whereas UEC was once a big United States player, now they've made a big play to the basin in Canada, to the Athabasca Basin, and they're one of the largest landholders there, project holders. And so, lots of bullish things for the uranium space, and lots of cheap companies. So they didn't stay all the way up either. Uranium companies have come back down, and I've been looking very closely to deploy more capital into some of those.
Right. And what I wonder about these deals that we're seeing in the space right now, what does that tell us about what could be coming? Because it is a very small sector, and I don't really know how much more can be done. What are your thoughts?
Oh, as far as what? I mean,
Companies getting
maybe you see some larger energy companies come into the space, right?
Mm-hmm.
Some larger diversifieds. Chevron used to be in the uranium game back in the day. You could see some large energy conglomerates, or even some utilities make their way into the space. Utilities haven't come back into the contracting cycle and still need to purchase their uranium for the future, and so maybe the future deal making comes from outside the space, but. Whether or not there's more deals, there doesn't necessarily have to be. What we're waiting on now is the price of uranium to go back up, right? I mean, you're going to see a time in the next 2 to 3 years, I'm pretty sure, of a plus $100 uranium, if not plus $150 uranium, just like you did in 2007. And the big question is always, well, when? And it can't defy gravity, just like gold stocks can't defy gravity. But I do think, once this inflation starts to subside, once we get back to growing the economy, you're going to see a ripping commodity market that includes uranium for sure.
Right. And okay, let's finish up. I have kind of what I think is a fun question. We'll find out if it is. If you look down into the future, 5 years, which asset could be a commodity or doesn't have to be? Do you think will have appreciated the most?
Copper.
Copper. Okay, we didn't even touch on copper.
I mean, copper's a great one. I mean, lithium's already had its day.
Yes.
Cobalt's very small. You can reduce the amount of cobalt in batteries. Nickel's fun to talk about sometimes, but copper is the one. Copper's needed not just for the cars, but for the transmission lines, for the charging stations, for the electrification of everything. And we saw it run to $5. It's come back down now below $4, and there's simply a dearth of assets that are online, and there's more that need to come online. And so there's some very exciting, very large deposits in Argentina and Arizona that had a good run a couple of years ago, and you're going to see those do fantastically well. I mean, there's going to be you give me a 5 year time frame. I mean, you might see $8 copper in 5 years. Yeah,
Wow.
it's going to be great.
Yeah, okay, so we can wrap it up there unless you had any final words of advice or things on your mind for investors.
No, just that stocks can go lower than you think, and it can happen when they've already been beaten down, and that again we haven't got into negative earnings growth for the large U.S. corporations, and cash isn't trash, despite what some of the YouTubers and the meme stock social media folks might have you think.
Okay, great. We've come full circle, so thank you for going through all that with me today.
I appreciate it. Thank you.
Yeah. Once again, I'm Charlotte LeCloud with the Investing News Network, and this is Nick Hodge.